Welcome everyone to today's webcast, How to Increase Project and Portfolio ROI with Dynamic Reallocation. My name is Ben Chamberlain. I'm the Chief Product and Marketing Officer here at UMT360, and I'm excited to talk today about establishing a framework for dynamic planning to drive more ROI from your project portfolios. So before we get into the agenda, quick intro on UMT360 for those of you who are not familiar with us. We are leaders in a space called enterprise portfolio management, and we're helping organizations really to digitalize investment planning and controls across both their business and technology portfolios, driving the financial transparency and strategic insights needed to make better decisions and drive business performance. Here you see some of the accolades that we've been awarded. I think relevant to today's session, the Cool Vendor Award we received from Gartner specifically focused on how to integrate financial management best practices with traditional execution-orientated project and portfolio management. We're also seen by Gartner as a visionary in the space of integrated IT portfolio analysis, the ability to bring together the key domains of IT, projects, applications, IT services, and infrastructure, and understand how they support the business and manage the business of IT. We're the only enterprise portfolio management solution built on the Microsoft platform, built on SharePoint with seamless integration with Microsoft Project Server when it's being used. And we're seen as twice in the last 4 years as the worldwide PPM Partner of the Year for Microsoft. So that being said, let's jump in to look at today's agenda. For the next 50 minutes or so, we'll really take a look at why organizations today are at risk of losing around 46% of the planned business value, relying on traditional execution-orientated project and portfolio management techniques. We'll look at why PMOs need to take a more strategic outlook or mindset in managing their project portfolios. And that's key for today's topic. So we're then going to zero in on some of the key factors of moving away from annual planning and adopting more of a dynamic planning approach, and some of the 4 key variables that we see that you need to address. We'll pause at the end for looking at additional analytics and insights you can gain from establishing investment planning controls across the project portfolio, and then next steps in Q&A. For me, some of the takeaways that I want to leave with you today is that traditional PPM, execution-orientated PPM, is simply not delivering the anticipated results. PMOs today need to adopt a more of a strategic mindset, move away from just focused on the tactical, to really become the CFO of their project portfolios. And you can do this by seamlessly integrating investment planning controls across your entire PPM lifecycle. So let's jump in. So as mentioned, traditional execution-orientated PPM capabilities are simply failing to deliver the anticipated results. Although the analysts don't necessarily agree on all the stats, they do agree there is a problem, and some of them you see here. The Standish Group saying 18% of projects fail to get implemented, or 43% of projects come in late or over budget. Gartner saying that 1 out of 3 completed projects experiences significant cost overruns, and the good old PMI confirming that 33% of projects fail to meet their business intent or deliver their business goals. Now, we've been working in the top-down project and portfolio management space for many years now, and what we've seen is that relying on just execution-orientated traditional PPM capabilities simply means you're at risk of not realizing around 46% of the planned business value from your portfolios. Or another way to look at that is 46% of the investment is at risk. And this is obviously a big number, and it's causing executives to question the effectiveness of their PPM teams. So let's take a look at how you could end up losing up to 46% of the planned business value from your portfolio. It's what I like to call the trifecta of business value erosion. And there are 3 main areas here: unreliable planning and innovation, poor project success rates, and poor budget utilization. So let's start with unreliable planning and innovation. 3 key areas that we'll drill into today. And this really focuses on some of the frailties that are apparent in traditional and annual planning. The first is no objective project selection framework. The second is the risk of inflated cost estimates early in the life cycle. And the third is moving from a project to more of a product-based investment approach. So let's start with no objective framework for portfolio selection. In a webcast about a month ago, we asked this question to around 250 execs that were attending. Which best describes your annual planning with respect to process, business case, framework, and metrics? And here you can see the responses. Around 13% had no templates and metrics and no ability to consolidate project requests. 51% had a central project repository, but the data was disconnected and being managed in multiple sources. 23% had a single system to capture all requests and were able to prioritize projects effectively. But only 14% were really relying on what I would consider best practice portfolio optimization techniques to select the best projects from a wish list. So one of the key problems is today, many organizations do not have an objective framework to selecting project portfolios, still rely on the sort of shiniest PowerPoint to get things funded, which does impact the value you can get from the portfolio. The second factor is the accuracy of cost estimates. Now, early on in the project lifecycle, often within a business case, the cost estimates can be order of magnitude wrong, can be inflated, for example, and that does have an impact on the value of the portfolio. If you look at this diagram here we have just a list of projects prioritized from 1 to 20 here, and you can then run down the list and draw a line where you run out of budget. So this first section here shows the projects that were selected in the portfolio. If the cost estimates are inflated, this is all you're going to be able to do. But if the cost estimates are more accurate, you're actually excluding projects from the portfolio early on in the life cycle. So you run the risk of losing business value because in theory you could have selected more projects earlier on. And if you don't have a framework to revisit those decisions throughout the year, that value remains lost. Conversely, if the project estimates are too low, you're causing yourself a downstream problem. Later in the execution year, you're simply going to have to start cutting projects as you run out of funds. So cost estimates significantly impact portfolio value. The last area focuses really on the quality of innovation. When you think about annual planning today, it tends to be a very bottoms-up activity. Let's say you're operating on a calendar year around about now, sort of the September, October timeframe. You start planning for the next year and gather requests from across the organization, standardize the demand management process, and then look to leverage techniques to optimize and select the best projects. But have you ever stopped to ask yourself, do I have an innovation problem? Am I simply just selecting the best of a bad bunch of projects? And that's the risk with more of this bottoms-up or project-based investment approach. What we're seeing, and this is certainly also echoed by Gartner, is organizations moving to more of a top-down approach, which Gartner calls a product-based investment approach, where you really start by treating the overarching business capabilities of processes in your organizations as the products in your business. You analyze those capabilities or processes and understand the gaps, and then you look at investing in those capabilities and processes to close the gaps. The benefit of this approach is you know what changes you need to make to your business to drive the performance you need, and you automatically result in a stronger set of demand of the candidate projects in your wish list, regardless of what optimization techniques you employ to select which projects to move forward with. So a top-down approach, a product-based capability-driven model, results in a stronger set of demand before you start to analyze the projects. Now, I could spend an hour just on this subject, and in fact, we have a webcast on September 30th, which I will share the link for at the end of this session, specifically delving into a capability-driven model to improve your 2015 annual planning. So those are three areas around annual planning and innovation. It's key to why we need to adopt more of a dynamic planning process. We'll talk about that more in a second. The next area is poor project success rates. We talked about 18% of projects failing to be implemented. If you fail to implement a project, you're not going to receive the value from it, so that leads to value erosion. We talked about cost overruns. You have a finite budget. If projects run over cost, you're either going to have to de-scope them, or in theory, you won't be able to do other projects that were planned for the year, resulting in value erosion. The last factor, which was more of a surprise to me 2 years ago, was around budget utilization. We ran a poll about 4 months ago where we asked the respondents, how much of the budget were you utilizing during the year? And around 33% of the respondents turned around and said they were leveraging less than 80% of the approved budget. So failure to start complete projects during the execution year can result in significant value erosion. Resource shortfalls and other aspects are going to be the primary drivers of this. Poor forecasting skills, as we'll talk to, are also a problem. Leads to money being held hostage in the portfolio. A classic example of that are projects that are trending under budget to date, but the PM is forecasting they're going to get back on track, and they never end up spending that money. That money is held hostage. The PMO can't reallocate it to drive more business value from the portfolio. So these really are the three areas of where value is lost in PPM. So that leads me to our first of 4 polls today. And the first question we have here is, which of the factors listed in the trifecta of business value erosion impacts you the most? And we'll pause here for 60 seconds or so. But the first is unreliable and planning innovation. The second is the poor project success rates. Budget utilization, the third. Or is it really sort of a death by 1,000 cuts and it's all of the above, or of course the option of none of the above? So if we look at this quickly, 50% of you said that actually it's the upfront annual planning processes, which is great because we're going to talk about going beyond that. And again, we have that webcast on September 30th that talks about a new way, a new approach to planning which drives more value. Project success rates, I think that is relatively low, but of course we do see that 29% of you responded that all of the above, so that obviously includes project success rates as well. And budget utilization. Budget utilization is interesting because even if you're utilizing all the budget, you can also ask yourself the question of how effectively are you utilizing that budget, which again results in a value question. So one of the key problems in the value erosion is today I think many PMOs are too focused on the important but yet tactical aspects of project delivery, things like schedule management, resource management, issues, risk management. Now, I'm not downplaying the importance of these activities. They're extremely important. What I am saying is, though, is that PMOs need to start to view projects as business investments, which they are, investments to drive revenue, reduce costs, align with compliance mandates. And if you agree with that definition, the PMOs have to take strategic responsibility for optimizing spend, maximizing value, and balancing the risk across the project portfolio. It's really like the PMO faces the daunting task today. They've got to wear their PMI hat. They've got to be the masters of execution, but at the same time become the sort of VC or CFO of their project portfolio and be masters of the business dimension too. One of the first steps, although this goes outside of the scope of today's session, in becoming an enterprise or more strategic PMO is to integrate investment planning and controls across the entire project and portfolio management lifecycle. And again, we could spend a whole webcast just dedicated to this, but I'll summarize it at the highest level. It starts with integrating both top-down and bottom-up budgeting. So being able to record enterprise budget, departmental budgets, look at setting strategic imperatives, and then gathering all the bottom-up project requests from across the organization. A part of that business development process is consolidating financial information as well as standardizing the different evaluation metrics that you're going to use, which feeds the annual planning process. Once projects are included and selected in the portfolio, we'll talk more about the ability to automate status reporting, which tends to be a problem for many PMOs, and how that can feed the process we're going to discuss today, a dynamic planning process where we're looking to continuously rebalance the portfolio throughout the year. Beyond the life of the project, being able to establish that important benefits realization framework to see if the project delivered the anticipated results. Now, one of the key challenges that organizations face in integrating investment planning controls is the use of inadequate tools. All too often, organizations rely on Excel to manage project financials, which Excel is extremely flexible, but it's difficult to govern, it's difficult to report against when the information is not consolidated within your planning and execution tool. ERP systems are used all too often as well. Although they provide the chart of accounts views needed for the finance team, they don't always provide the PPM teams with the end-to-end project and portfolio financial views they need to manage project and program portfolios. Also, PPM tools tend to be more focused on the tactical execution aspects of project delivery and lack the sophistication needed to successfully manage project and portfolio financials. So solutions like UMT360 are really looking to reduce the reliance on Excel, reduce the reliance on Excel, and really bridge the gap between both the ERP and PPM systems to provide that financial intelligence, that financial transparency and insight across the project portfolio. But today we're really going to focus on dynamic planning, the ability to understand the economic impact of underperforming projects and take corrective action throughout the year to rebalance your portfolio. Decide whether to reinvest in existing projects, take money back from existing projects, bring in new projects to optimize spend and maximize value from the portfolio. So we're going to go into dynamic planning next. But before we do so, let's pause for the second poll. So what tools are you using to manage your project and portfolio financial controls today? You can choose multiple here. I'm relying purely on my PPM solution, Excel plus a PPM solution, ERP plus a PPM solution. I have a custom offering. We're not really focused on financials at this stage. Let's look at the results here. So 22% using the capabilities resident in PPM solutions. 54%, so a majority here, using the combination as I thought might be the case of Excel plus an execution-orientated PPM system. 21% leveraging ERP system plus the PPM solution, potentially even Project Server as the PPM solution, which we certainly support in UMT360. 35% have a homegrown custom solution, or even off the shelf. That would be a package solution for managing financials, and 16%, not managing financials, at least at this stage. So let's dive into dynamic planning, what it is, and I kind of loosely described it as rebalancing the portfolio in the last slide. But rather than use my words, I'm going to use a quote here from Frank LaRocca. Frank LaRocca has been working with UMT for a number of years, and I really see him as a key practitioner in how you manage the strategic nature of project portfolios, from annual planning through to the dynamic planning methodology that we'll talk through today. Frank is the Director of Business Improvement Services at Con Edison in New York, and his words are here. The reality is that conditions fluctuate and assumptions made in annual planning are often flawed. Dynamic planning provides executives with the financial and strategic insight needed to gauge the economic impact of poor project performance and improve decision-making to reallocate funds to optimize budget utilization and maximize ROI across their portfolios. So it is that rebalancing of your portfolio on a continuous basis, monthly or quarterly throughout the year, to take corrective action to do two things: optimize the spend, make sure we've got a fiscal responsibility, as well as maximize the intended business value, or ROI, from the project portfolio. So I'm going to go into the sort of four key things that I think we need to consider when looking at a dynamic planning framework. Now, it would have been obvious, and I excluded it from here, to say we need a way of gathering demand from across the organization so we can effectively compare and contrast it. That's a given, but didn't quite make my top four in the list here. The first is a need for a new metric, strategic yield, to effectively evaluate projects throughout the life. The next is we have to improve our forecasting capabilities, and we'll talk more about that. The automation of status reporting and variance analysis is a key driver, a key input into the dynamic planning process. And we want to empower and escalate decisions to our steering committees to make these decisions on a recurring basis. So we're going to dive into each of these in more detail. First, looking at strategic yield as a new metric. I talked about becoming the VC or the CFO of your project portfolios, and what we've seen is the rise of a new metric, a business-orientated metric for managing your project portfolios as business investments. And it's one we use called strategic yield. And strategic yield is really derived based on understanding the strategic contribution or the strategic value of your projects divided by its cost. And it really is a bang for the buck metric. It looks at the bang for the buck of competing projects and programs. Again, value divided by cost, giving that strategic yield ratio. And it's a great metric used to compare and contrast projects no matter where they are in the process. It has been traditionally used in portfolio optimization, in annual planning. But I can also assess the investment viability of new projects versus in-flight projects. It's a dynamic metric, so if value stays the same and cost increases, strategic yield automatically degrades, providing that kind of investment barometer, an early warning indicator in terms of the investment viability of projects in your portfolio. The beauty of this metric is not just a project level metric or a program level metric. It can also be aggregated to the portfolio level and allow you at that portfolio level to gauge whether your portfolio is continuing to deliver the anticipated value, and if not, take corrective action. So a very powerful metric, and again, it's really one used to manage the business side of your portfolios. But any metric is really only good as its inputs, and we do run the risk of kind of garbage in, garbage out here. So I think it's important to pause and take a look at how to derive a stronger strategic value score and better cost estimates and manage costs throughout the life of the project to maintain this strategic yield metric. So let's look at how to derive a better strategic value score. And there's sort of 4 areas we need to consider here. We really want to understand the project's contribution to the strategic imperatives of our business. So starting off by defining a good set of business drivers is key. They should be actionable. You should be able to take action. There should be projects and programs that you can execute against those drivers. They need to be measurable. You need KPIs to measure each business driver. And in turn, they also need to be unique. What we've seen is you should have no more than or no fewer than 6 and no more than 12 business drivers. More than 12 business drivers, there tends to be overlap between them. We want them to be unique. You also need to look at covering the full spectrum of your business. On the chart on the right here, we see business drivers around revenue growth, existing markets versus new markets, product quality, customer satisfaction, employee satisfaction, cost reduction, and efficiencies. These are sort of the key areas. Risk is another one that you want to cover across your business drivers. So having engaged the executive team to understand what the business drivers are for the upcoming planning period, we need ways to objectively prioritize those business drivers. And there's certainly different techniques that you can use to do this. But the really important thing here is to engage in a dialogue, to openly discuss the relative priorities of each business driver. It starts really by prioritizing business drivers individually with key stakeholders. So working with the CIO, other C-level stakeholders in the organization to understand their business driver priorities for the upcoming planning period is key. Then bringing everyone together once you understand the potential divergence in the group to have that open dialogue to drive consensus priorities around the business drivers for the upcoming planning period. And again, we could spend 20 minutes just on this particular aspect of today's discussion. And what we want to really do is look at recording relative priorities. We need that relative scale, not just ranking business drivers from 1 to 7, but understanding, as you see here on the right-hand side, our top business driver has 28% of the weighting, our bottom business driver only has 4% of the weighting. That relative scale allows me to look at investment alignment. If I had $100 to invest on my business strategy and I wanted total alignment, I'd stick $28 on the top business driver, $4 on the bottom business driver, as shown in this image. So having set and prioritize a strategy, which is a key input into the process, we need a way of assessing a project's contribution on that strategy. And you can do so by establishing what we call impact statements to understand the extent a project will contribute to one or more business driver, and it can contribute to more. And we use those KPIs defined for business driver to derive those impact statements. And ultimately, you're going to complete a survey to derive a score for the strategic contribution or strategic value of that project. And that's the important aspect here, is deriving that absolute score that lives with the project throughout its life and can change as the assumptions change against how it impacts the business drivers. So that results in a stronger score that we can use to assess the project throughout its life. Let's take a look now at the financial side of things, how to improve the quality and accuracy of the overall project portfolio financials. Again, what we tend to see early on in the annual planning process is cost estimates are very high level, often captured in disconnected systems like Excel, making it difficult to report against. So the first key imperative here is to standardize financial structures within your planning and execution system and look at consolidating all financial information within that to drive both the project, program, and portfolio financial views. We do see the concept, and this is number 2, of financial amplification throughout the life of the project. Being able to control the right level of financial information needed at each stage in the life cycle is key. So you may start off capturing information on a quarterly basis early in the life cycle, drill down to monthly later in the life cycle. But establishing those governance controls to capture the right data at the right time is certainly key. We talked earlier about integrating both top-down and bottom-up budgeting. The ability to bring together organizational budgeting as well as project-level estimating and budgeting is certainly key. Maintaining an auditable record of funding approvals, being able to look at different stages in the process and what the financials were at different stages in the business case is key. Also understanding the cost of projects at each stage in the business case development also allows us over time to build a picture of estimating accuracy. Once I know the total cost of my project, once it's complete, or even the forecast cost of the projects, I can start looking at estimating accuracy across the portfolio. So I know early on in a business case, I'm plus or minus 50% accurate, within a department on average, and I can start to hedge that into my planning process. We'll talk more about that. Being able to standardize performance metrics and drive variance analysis, and of course integrate with the system of record, the ERP system for actual committed costs, is certainly key. Not looking to replace the ERP system here, we're looking to make sure that PPM teams have all the financial information they need in the way they want to see it, versus seeing it the way the finance team wants to see it. And as we'll talk about in a moment, establishing a change request management process is key, one of the key drivers to dynamic planning, to be able to request more funds, give back money, and establish the governance controls around that. Again, we can go a lot deeper into the investment planning controls and how to drive better cost and benefit estimates across the life cycle, but just a few points there. So next, the second point, we want to build a culture to improve our forecasting capabilities. Forecasting is the bedrock. It's the foundation to dynamic planning. Poor forecasting kind of invalidates the whole dynamic planning process. The first thing to do, and it's an obvious statement, is to invest in training your project managers. Why that's important is often we go to customers and we ask for forecasts. And project managers simply just take the approved budget and subtract the actuals and say that's what's remaining. That's not what we're looking to do here. We're looking for a strong gut feel in terms of the money you will need, whether it's higher or lower, to complete this project. Working with organizations, what we've often seen is there's cultural aspects to be addressed to improve forecasting capabilities. The first is that costs tend to be inflated, sometimes because there's a fear to go and ask for more money. Fear that you'll be pulled up in front of the VP and asked why you need more money, what's wrong with your planning capabilities. So we need to reduce that fear. We need to have the understanding that you will receive more funds for your project, assuming its strategic yield warrants that. And by the same self-token, we also want project managers to feel that they can give up, they can release funds if they're forecasting less spend than the budget. They can release funds for the greater good of the portfolio. The portfolio thinking, the portfolio concept is the sum is greater than all the parts. So we want to be able to release funds so the PMO can reinvest those funds in projects that can maximize the overall value from the portfolio. Again, a lot of work to be done here, but it's not just training your project managers. Sometimes it's changing the cultural aspects of your business to empower better forecasting. Third, automate status reporting and variance analysis. What we've seen here, and this is echoed in this other survey, which was part of the same webcast from the previous survey I showed you, is that PMOs today often struggle to automate status reporting across their project portfolios, the monthly cadence of status reporting. Spend far too much time manually reconciling data and manually building reports. So again, we asked this question: which best describes your current status, performance, and tracking capabilities? And respondents, 30% no standardized performance metrics across the portfolio, 56% had standardized metrics, but the work was very manual for project managers and PMOs to complete the status reporting process, and only 14% saying this process has been automated. So there's a lot of work to do in terms of automating that process so the PMO can spend more time analyzing and taking corrective action versus manually reconciling the information. So this is one of the things that where UMT360 helps. It looks at a process to automate status reporting and drive variance analysis. It's a pretty simple workflow, which starts off with the PMO being able to open status reports and notify project managers a new status reporting period. Now, we're maybe in September reporting on, first week in September, reporting on the health of projects in August. So notifying that a status report is open and the time window it needs to be completed in. At the same time, integrating with the system of record from a financial perspective to pull in the actual committed costs from the project from the ERP system into the project portfolio view is key. So the PM can then complete their status report, capture actuals, accruals, forecast remaining costs, complete the other metrics and health assessments of the project within that. And then raise the change requests. Change requests are key. We'll focus more on that. Raise change requests if they require more funds. Raise change requests to release funds. And then submit and lock the status report. Submitting and locking the status report basically notifies the PMO that they're complete, and the reports can start to be built out for those projects. And the report on the right here is an example of one of the reports in UMT360 that's fully automated on top of the status reporting process. So at a click of a button, these reports are updated for the current period. But based on the variance analysis, what we're really looking for here is that strategic yield metric. In this example, this project is trending 32% over budget, and the leading indicator here is our strategic yield. We're showing the value stayed the same, the cost increased. It's automatically showing a degradation in strategic yield, and it's that early warning indicator that maybe you better buy across the portfolio. But what we're also looking to do is drive this variance analysis, and we're looking to group projects into three key areas, or CAMs. The first one are projects that are forecasting forecast greater than plan or greater than budget. So Simpson's forecast cost greater than approved budget. And the action we're expecting here is for the PM to request more funds. So range of what we call a redirect to request more funds. Negative variance is the opposite. These are projects with forecast less than approved budget. And what we're expecting to do, again, working on our forecasting accuracy, is project managers to freely release funds so it can be reinvested across the portfolio. And the last category here is what I call the wolf in sheep clothing. These are the projects that to date are running under budget, but the PM is forecasting they're going to get back on track. And you want to watch these ones closely because they result in the Q4 budget utilization nightmares. So at a certain point in time, if you really don't think the money is going to be spent, you're going to look at taking it back more aggressively. So if the negative variance is more of a give back by the project manager, you can think of these more of a force release or a take back from the PMO so the money can be reinvested before it's too late and you have no time to react. So again, this is the important views that we're looking to drive from a variance metrics perspective and the expected actions we see from the PMs. So poll number 3, how much time does your PMO team spend collectively supporting the monthly status reporting and building reports? So how much time do you spend managing that whole process, manually building reports and reconciling data? And here you see the options here. Less than 25 hours, and this I've assumed a monthly status reporting period here. It can be a different cadence. Less than 25 hours, between 26 and 50 hours, between 51 and 100 hours, more than 100 hours. So this is a stark contrast compared to the last time I ran this poll, but we have around 48% of you saying that you spend less than 25 hours of a PMO's time collectively managing this entire process. That includes reconciling all the data that form the comprehensive status report, as well as building out reports. 28% up to 50 hours, 15% between 51 and 100, and 8% more than 100. Last time I ran this poll, it was actually skewed more towards the center, with majority around 51 to 100 hours. So last but not least, we want to empower our steering committee to then make decisions. We want to automate the collection of this information, present it in a manner where we can quickly make decisions to optimize spend and maximize value. Again, we ran another poll here asking the respondents to best describe how their organizations, or what their current capability is around taking corrective action and dynamically reallocating funds across the portfolio. And you can see the answers here. 48% actually said they do not have a process around dynamic reallocation as we define it. Another 12% are planning to, so 60% are either don't have one or are planning to have one in the future. The 40% or 39% here do have a process, but again, it's a manual-driven process versus automated, and a whopping 1% said that they have an automated process for dynamic reallocation. So again, there's an opportunity to establish this process for many organizations, and certainly to automate it and streamline that process for organizations that already have some of the concepts in play. So let's take a look at what the dynamic reallocation process entails. This is now we're moving to the sort of portfolio level view, and the handshake or the handoff here really comes through those change requests. So the result of those change requests was either to give back money, release money where it wasn't going to be spent, or aggressively take money back through the force releases. And what happens here is any money released isn't questioned. It's just taken back and put into the pot. What the steering committee looks to do is evaluate additional fund requests and also the takebacks to approve any money that needs to be forcefully taken back. But before they can evaluate whether to fund more or give more money to existing projects, also need to look at competing projects in the pipeline, new projects that haven't yet been approved. And that's the key, to balance the new projects in the portfolio with the existing projects in the portfolio to maximize the overall value. So this report on the right here really shows you that you can focus on understanding what your current budget utilization is, understanding what the current strategic yield from your portfolio is, what available funds you have to be reinvested based on the budget shortfalls or the releases that have been made, and start to look at the total number of change requests requesting more funds versus projects that you can invest which are new in the pipeline. And it simply it shows you based how those projects stack up using that strategic yield metric. So you can see committed in this view shows you projects that are in flight. Pipeline means new projects. So you can see quite quickly whether or not you should look at investing more in existing or bring in new projects in the pipeline to not only maximize the value from the portfolio, optimize the spend, but also maximize the value from the portfolio. So again, it's that rebalancing of existing versus new projects to maximize the overall portfolio. And being able to see this information in an automated manner is key. The output of such a process is shown in this report here, where basically, regardless of whether you're doing this on a monthly cadence or a quarterly cadence, as this suggests, at the start of the period, you understand the available budget. You're able to track in terms of how much money was released back, how much additional funds were requested through redirects, and how many new projects you started in the year. And at the end of the period, understand the surplus and deficit, and then start the process again in the next reporting period, in this case quarterly. But the key to this process is always having a key eye on two things, or a keen eye on two things: maximizing the budget utilization, and also at the same time ensuring you're maximizing the strategic yield from your portfolio. So the last poll. Although we just touched on some of the aspects of dynamic planning here, I wanted you to rate how well integrated you feel that your investment planning controls are today across your entire PPM lifecycle. This includes establishing those financial capabilities across the whole lifecycle, from top-down budgeting through estimating and evaluation of different project portfolios, annual planning, financial performance management, dynamic planning, as well as beyond the life of the project in benefits realization. And some simple answers here from, I feel that we're fully integrated based on the definition I just gave, to partly integrated, moderately integrated, to not integrated at all. Interesting. So this is the way I would have predicted this poll to turn out. I think the last poll surprised me a little bit in terms of its results. But 5% saying that I think we're fully integrated based on the definition I gave, partly integrated 18%, 33% moderately, and 43% not integrated. Of course, the devil's going to be in the details here, understanding exactly what moderately integrated means versus partly integrated or not integrated. But I think we can see, or the takeaway from here is there is definite room for improvements to establishing those investment planning and controls, which really is the first key step in driving some of the foundation to provide some of the insights that I just stepped through in a dynamic planning process. So really, from the dynamic planning process, it was just one small aspect of some of the insights that you can get in terms of once you've established the investment planning controls across your portfolio. Again, we've just touched on a fraction of the capabilities today. But once you have that foundation of integrated investment planning and controls, there's a huge amount of intelligence that can be derived from that. And here's just a few examples just to sort of whet your appetite. The first one here is doing a better job of being able to actually project the spend. And this chart shows how you can leverage actually historic data to showcase spending patterns. So if I know the average spending patterns of previous years, I can know roughly how we're going to spend in the current year. The natural tendency is to be aggressive in forecasts, especially as you move through the year. It seems to be a spike in Q3, Q4 as the year starts to run out. But you can go back and say, look, in previous years, we've always shown this spike in forecasts, but our spend patterns have been pretty consistent. There's no reason to think it won't be consistent this year, and start to very effectively start to predict, within a couple of $100,000 where you think you'll end up, as early as sort of Q2, Q3 in the horizon. Very interesting to be able to leverage both current trends as well as historic trends. Next view here is looking at budget utilization. Now, I said budget utilization was one of the key areas you can lose value as part of that trifecta story. Be able to look at how you can improve budget utilization over time. For many of our customers, actually budget utilization is one of the reasons they want to do a better job of integrating investment planning and controls. And be able to look at how you can improve your budget utilization over time, which in course in turn means you're gaining more value from the portfolio. So this chart shows how the movement per year in terms of better utilization of the overall budget, and you can see started in 2009 with 82%, all the way through to 2011 rose to 97% and so forth. Another key area is looking at estimating accuracy. Because we're able to record budgets at different stages in the project estimate, we can start to look, once we know the forecast cost or total cost of projects, look at overall estimating accuracy. And obviously, if your forecast equals your budget, you got 100% utilizing all the funds. But you can simply plot out the projects here based on the importance, first on their budget deviation, and use that to plot and understand at different stages in the process, by department, by organization, what the average estimating accuracy is. So I can say with some certainty, at this early stage gate, funding gate in the process, in this department, we're plus or minus whatever, 28% in this case, accurate from the portfolio. And I can hedge that into my overall planning processes. Also, because you have that information as granular as the project level, you can actually start looking not only just at estimating maturity, but on a departmental basis or a portfolio basis, but also down at the individual level. So we can say, okay, look, this project manager or stakeholder needs to work on those estimating capabilities. So a lot of levels, a lot of intelligence that can be derived from that. These are just sort of four views that I threw in, and certainly not definitive, but because we started with the importance of prioritizing business strategy and generating that relative scale in terms of business driver priorities, also have the ability at any point in the process to understand investment alignment. How am I investing proportionally to my business drivers, to my business strategy here? So what you're looking for, as shown here in the reduced expense base bar, you're looking for areas of concern. I'm over-investing by a factor of 2 or so in reduced expense base. There may be good reasons for that, but you get to ask the question why. Should I be investing more in my top business driver, increased share in existing markets? Because everything's connected, it's very easy to generate these views and understand the strategic imperatives as well as the financial insights that we've described earlier. So just some additional views that you may be able to take advantage of once you've established those investment planning controls. And this is not a definitive set of views. There's many, many more of interest. So we've got about 6 minutes to run. So I'm going to wrap up now and always do so with a kind of action plan. What should we think about doing next? The first thing I would say over the next 7 days is take a look within your organization and look at how well you're doing the status reporting. How automated is your status reporting? How integrated are your investment planning and controls? And what's the room for improvement? Over the next 30 days, please feel free to reach out to the UMT360 team to establish or set up a virtual or in-person envisioning workshop where we can look at doing an assessment of how well integrated your investment planning controls are, what are the benefits of integrating those, and how would you go about that in a phased manner. We run a regular cadence of webcasts much like this, and the next one I alluded to earlier is on September the 30th, and it's the next part of our strategic PMOs series. And it's topical based on the time of year we're at, and we really want to look at transforming your 2015 planning process, moving from that sort of project-based approach that we discussed today into more of a top-down driven capability-centric model. So that webcast is happening on September 30th, led by our CEO Mike Greer. And again, we'll look at the frailties of annual planning. We'll look at how you can actually improve innovation and the value of the resulting demand by taking that top-down approach. And it'll just be interesting as many of you are who are at least operating on the calendar fiscal year are approaching this the topic of annual planning for 2015. So the link to that webcast has actually been shared through the GoToMeeting chat function. You can also go to UMT360.com and register there too, as well as through Projects at Work as well. So again, with that, I'd really again like to thank everyone for attending today. Please look out for future webcasts in the Strategic PMO series. We're actually doing roadshows in cities near you over the next 12 months. First one in Chicago at October 21st, I believe, and then Houston in early November, and then we'll continue the rollout based on interest in different cities. So again, thanks for attending. Please reach out to UMT360 if any questions.